publishers of all the data got to be careful too, because one thing they need to move before they really pause or even back interest rates up a little bit is they need unemployment rate to go up. And politically, nobody wants the unemployment rate to go up, right?
Well, I think we hammered the indexes and the returns and what the markets have done year to date. And I know that it's one of those things we don't typically get as many calls or questions, like Jason said, on why the market's up.
Yeah.
But it is something that we pay attention to. And some of the data points that we've talked about for the last year and a half has been inflation, Fed raising rates. Sounds like at least now we got the debt ceiling behind us. The other things that
so
have kind
surprising.
of run the line. Yeah, right. It got
that
through.
Was one prediction we got right.
Yeah, right. So, what's kind of the update? I know it kind of gets repetitive here every month and every quarter that we're talking about inflation and Fed, but it's still really what's controlling a lot of these headlines right now. Any updates on kind of what inflation's done this year and where we're at, as well as the Fed and kind of what that looks like?
Yeah, so I don't know if I have the chart for it, but basically inflation is just like, looks like a pyramid. It went all the way up to 9.1%, basically just a year and a month ago. And we were down to our lowest level in June since March of 2021, actually, which was down to 3%. It did tick up to 3.2 this last reading. I think they're expecting it to tick up just a little bit again in the next reading. So inflation-wise, we are, we're back. We're not in what the their Fed target, which is 2%, or even historical numbers. But we're well off where we were, a year ago with 8-9% inflation. So, and again, like Kyle mentioned, that is driving the market. That, and then we'll talk about now the Fed funds rate, which at this point is probably topped out.
Well, what's pinning up inflation is what we got: rents that are still high, right?
You got energy bouncing back.
Energy has come back, even though most commodities are down. I think Kyle quoted those numbers earlier. Most commodities are down, but specifically, fuel, gasoline, oil, those things have drifted back upward. And again, with we got to talk about it at some point. How I'm certainly surprised that the housing market has price levels have stayed up. Deals are way down. New applications for mortgages are way down. Interest rates are certainly up for those mortgages, but the pricing has stayed, relatively high just because there's not a lot of supply. Who wants to swap out a 3.5% mortgage, move across town and take out a 7.5% mortgage? Not a lot of people are interested in doing that. So
with inflated prices too.
The inflation up.
Inflated prices and higher interest.
No question.
The one thing that's happened, I started to talk about a little bit, Fed funds. So the Federal Reserve recently raised rates again in July, but at this point, all markets predict, the future of these rates. And you can see at the 525 to 550 is where it's at now, and that's in basis points. So that's 5.25% to 5.5%. And the probabilities going forward are all, the bluest is the highest probability, and then the yellow. You can see that there's not any rate increases priced into the market right now. They're expecting rates to basically hold through, call it, March first quarter of 24, and then eventually see cuts. Again, the farther out you get, these are probabilities, right? And you're talking about estimates. So the farther out you get from current day, obviously the less reliable they are because more can change. But this is kind of where we're at. So at this point, 5.25 to 5.5% seems like the terminal rate for the Fed. Things can change, but that's where the market sees it going forward. And that has a lot of impact on markets where they're going fixed income, and we'll talk about that a little bit.
Adam, what I might pull up, see if I can grab this chart. It's a rate forecast chart. I was going to mention it later, but it's almost the exact same information you just discussed, but it shows it in a visual.
Okay.
And it's the same kind of story where basically, see if we can grab this. If not, we'll pull it up later. But it's the same message. It's talking about where rates will be down a year from now, and the conversations come up too when we look at why are money markets paying more than a 10-year bond, and that's really on that expectation that rates are coming down. There we go. Got the chart.
We made
it. So this is This is forecasting. So for anyone that's watching right now, you can see that expectations, and like Adam said, subject to change. But right now, rates may go a little bit higher, but for the most part, we've plateaued, and we'll probably hang around this level for probably a year, maybe a little less, but north of 5 for probably a year, and then depend upon the state of the economy, recession or otherwise, is what we might see when we might see rate cuts.
And Jason, that was something we were talking about is, for the last year is, okay, well, when are they going to pause rates? When is that going to stop? And then eventually we even talked about potentially earlier this year, we were talking about maybe even a rate cut at some point in the fourth quarter. And obviously it's data driven, and the data hasn't warranted, and the Fed hasn't made any decisions here. But I do have a chart that shows historically, clients say, okay, well, rates have been high. That's great. But, when are they going to start coming down? And they say about historical averages around 10.5 months from the last rate hike to the, essentially first rate cut. So we're still not there. We had that pause, 2 months ago, and then a hike here again in July. So we'll see if that was the last hike, like we're kind of looking at right now, and then potentially anywhere that 10.5 month range, which kind of is in line with what the forecast are showing on those graphs and those charts is, like I said, almost a year from now. So,
yep. And we're going to hit on this.
The publishers of all the data got to be careful too, because one thing they need to move before they really pause or even back interest rates up a little bit is they need unemployment rate to go up, and politically nobody wants the unemployment rate to go up, right?
Right before an election.
That makes it difficult for the people who need to publish the data, to not go back and reformulate it and redefine. Well, here's how we're gonna. I mean, they've done it a couple times with inflation, and done it a couple times with unemployment, and so. And recession, that was sort of the big glaring one last year. Remember? It's 2 quarters. Well, maybe it's 2 quarters plus another quarter. So they got to be careful there too.